Hello, and welcome to the 2026 Property Market Update for Victoria. My name's Angus Moore. I'm the Executive Manager for Economics at REA Group. I'm going to take you through a bit of a high-level overview of what we're seeing in housing markets, as well as the economic conditions that are underpinning that. To that end, I'm going to start with that economic backdrop, paint what we're seeing in the economy and how that's affecting housing markets. I'll then talk about what we're seeing in the established market, focusing on home prices, but also what we're seeing in terms of activity across Melbourne and regional Victoria as well. I'll then talk a little bit about rental markets, both because they're interesting in their own right at the moment, but also because of what that's meaning for investors, who've been a really important part of the housing market story across Australia for the past couple of years and increasingly in Victoria as well. And then I'll wrap up with a few themes that I think will be important for 2026 and beyond. So let's start with that economic backdrop. And here in 2026, the kind of economic topic du jour is what's happening with inflation. So let's start there. This chart shows what we call underlying inflation. This is the measure that the RBA prefers to focus on because it strips out the sort of temporary, transient, one-time effects that don't really matter for thinking about, where inflation's at and where it's going over the longer term. Think things like, fuel prices, electricity subsidies, those kinds of things. Those all get stripped out of this measure. Couple things you'll note from the chart. First, inflation got well above the RBA's target band coming out of the pandemic. And that's the reason why we saw, rapid and successive interest rate hikes from the RBA. It was because inflation was so high and they were looking to get it back under control. But the second thing you'll notice, if we, kind of fast forward through to 2025, is inflation actually came back down inside the RBA's target band, not by a lot and fairly briefly. But that was why, things last year we were starting to expect, we were seeing rate cuts, excuse me, and why we were expecting to see some more. But then towards the end of the year, inflation picked back up. And then you can see in the red there, which is the RBA's forecast for inflation, they're expecting it's going to continue to pick back up and it's going to stay outside their target band for, 18 months or so. That's why we've seen them hike already, why that outlook's really changed. It's all down to the fact that inflation has been a bit more persistent and a bit higher than had been expected. What that's meant for mortgage rates is they're going up, obviously. This chart here is showing the average mortgage rate for a new owner-occupier borrower. So, if you're a new owner-occupier and you went to your bank, on average, what rate would you be able to get from that bank? You can see, the rate cuts that we saw last year took mortgage rates off their highs that we had been seeing earlier in 2025 and 2024. But that's already started to be reversed with the rate hike that we've already seen. And with another at least one and 40 to 50% chance of a second hike towards the end of 2026, mortgage rates are likely to get back towards the sort of levels that we were seeing. At the moment, it's not expected to be as high, and that's just because that second rate hike, excuse me, is not baked in. It's still a 40 or 50% chance, but it will certainly reverse some of those cuts that we saw. As I just spoke about, inflation's been the key thing driving this change and why we're seeing the hikes. But it's not the only factor that's mattering for inflation, for interest rates and what the RBA is doing at the moment. And the other factor is the unemployment rate, which is what I'm showing here. So the purple here is showing the actual unemployment rate over the last 5 decades or so. And you can see there at 2025, it's sitting around sort of the low fours. The unemployment rate is very low by historical standards. It's not the lowest we've ever seen. Coming out of the pandemic was lower, but it's still very low relative to what has typically been true for 5 decades. And importantly, the RBA forecast in red expects that to continue. They're expecting it to continue to drift up a little bit as it kind of has been for the last few years, but not by a lot. And even by the end of their forecast horizon, still going to be fairly low by historical standards and probably still, below or maybe around what the RBA considers neutral. It's a little bit of a slippery concept and hard to exactly pin down, but the idea of neutral is the sort of level of unemployment, pace of economic growth that's consistent with inflation being within the RBA's target band. If unemployment's too low, that puts pressure on wages, puts pressure on prices, and that pushes inflation up. So, the fact that unemployment is very low and inflation has moved higher is, a big part of and kind of what's been driving the reason we've seen the RBA already hike rates. So maybe a more interesting question is why is unemployment so low? And why, if you look at the chart there, why did unemployment actually move down towards the end of 2025? Part of the story is that consumer spending has actually been picking up. So this chart here shows consumer spending relative to 2019. You can see that big fall that we had there during the pandemic. And then as borders reopen, as the economy reopens, towards the end of 2021, you get that big surge in spending as everyone starts going out and spending again. But then if you fast forward through sort of 2023 and into 2024, you can see that consumer spending more or less tracks sideways. And that's kind of particularly remarkable at this time because we're seeing really strong population growth during that period. And so per person, per capita, consumer spending was pretty soft through that period. But in 2025, you can see consumer spending starting to grow again. And this is in a period in which population growth has actually slowed down again. So, per capita, even a bit firmer again. That all points to, a relatively solid kind of consumer spending, supporting jobs, again, mounting the case for a rate hike. Another way to see, perhaps more complicated way to see is this chart here. What this is doing is showing how different types of spending in the economy are contributing to overall economic growth. So in the red is private sector spending, in the blue is public sector spending. And the way to read this chart is that the bigger the bar, the more that type of spending is contributing to overall economic growth. And if we focus in on 2024, 2025, you can see that those red bars are really very small through most of 2024. The private sector really wasn't contributing a lot to economic growth. But public sector was through that period. We were seeing fairly solid growth in government spending, in infrastructure, and that was supporting growth through this period. But then as we get into 2025, that story starts to reverse. Public sector spending starting to slow down, and we're seeing pretty strong growth in private sector spending. That's that consumer spending that we were talking about before, but it's also business investment. And so that, is again supporting job growth, pushing up inflation, and why we've seen hikes from the RBA. It's certainly something they pointed to in the post-decision statement as to why they were hiking rates. So let's move away from kind of pure economics for a while and talk something a little bit closer to housing, which is population growth. Chart on the left here is showing annual population growth for Victoria in the orange and for the country as a whole in the purple. Two things that you'll take away from this chart. First, we've been through a period of very strong population growth in recent years, but that's starting to kind of abate. We're coming back to a more typical pace of population growth now. That's true in Victoria, that's true nationally. And we'll talk about why in a moment. But the other thing you'll note is that Victoria typically grows a little bit faster than the country as a whole, but that was very much not the case during the pandemic. In fact, Victoria was shrinking at a relatively reasonable clip, 1% a year during the pandemic, which was not true for the rest of the country. And the reason for that is the chart on the right. So the chart on the right just takes Victorian population growth and decomposes it into, what drives growth in the population. So in the grey, which we can mostly ignore, is what we call natural increase. That's just births and deaths. We can mostly ignore that for our purposes. In the blue is net overseas migration. And that's why we saw a big increase in population growth in recent years and why population growth has come back to normal now. When borders reopened, we saw a lot of people coming into Australia and very few people leaving because no one had arrived for the preceding 2 years because borders have been shut. So there was no one here to leave. What that meant was the net in less out was very, very strong. Here now, 4 years later, post borders reopening, that process of adjustment has kind of worked its way through. And so we've now got people leaving again, people that arrived in 22 and 23 are leaving. So that inflows less outflows is back to a more typical pace relative to what we've seen in history. And that's why population growth has come back down. But in many ways, it's the red bars that are actually the most interesting ones for Victoria. And that's net interstate migration. Victoria has typically, not always, but typically seen more people moving to it from other states than leaving it for other states, meaning the red bars are usually above the grey, but not always throughout history. But during the pandemic, that was very much not the case. Victoria saw a lot of people leaving, very few people moving there, and saw big negative detractions from net interstate migration. That's why population growth turned negative over that period. That process has largely, not completely, but largely abated now. You can see that, those red bars are, back to close to zero, meaning as many people are moving in as moving out of Victoria. Now, again, that's still a little below average for Victoria. Victoria does usually still see people on average moving in versus moving out. Uh, but it's no longer going to be the drag on population and on housing demand that it was, during the pandemic. Just to unpack it even a little bit more, kind of where people move in Melbourne, the chart on the left here is showing internal migration within Melbourne. So that is, where do people that already live in Melbourne move if they move within Melbourne, or from elsewhere in Australia move to Melbourne? And you can see a pattern that we see across the country, which is that inner city areas people typically on net move out of and move towards greenfield areas, more affordable areas of development. Now, that's not to say that these areas are losing population overall. Once you, as I am on the right here, factor in overseas migration, those inner city areas are still growing. And, particularly for the CBD, still growing quite strongly. But, the difference is often, people come in from overseas into those inner city areas and then move to elsewhere in the city. And that elsewhere is typically those more affordable areas. Now, not everyone that moves subsequently is going to be looking to buy, but that they often will be. And so, that can be an important determinant of housing demand, which is, I think, a nice segue into talking about home prices. So let's do that. Chart here is showing what's happened to home prices over the last 6 years. Melbourne has had a fairly sluggish run, particularly since the RBA started raising rates in 2022. You can see that run up that we had during the pandemic. Prices were up 20% across sort of 2021 and into the start of 2022. Pretty strong growth, not as strong as we saw in some other parts of the country though. But then the RBA raises rates, prices come down a bit, and then have been largely tracking sideways through to 2025. 2025 was notable though, in that we actually started seeing some pretty consistent growth in Melbourne and in regional Victoria through 2025. But as we got to the end of last year, we did see modest home price declines in December and January in Melbourne. Now, January is obviously a light month for sales, so hard to know exactly, where prices are tracking over that period. But it does look like we saw a little bit of a softening towards the end of last year. That was true in Sydney as well. You can see on the right, Sydney has a pretty similar story to Melbourne, not quite as acute slowdown over the sort of post-rate hike period. But you can see prices were pretty soft through 2024 in Sydney, rose through 25, and then kind of tailed off right at the end of the year. Part of the story here, and we'll talk about this a bit later when we talk about activity, is there's just a lot of choice around for buyers, particularly towards the end of the year in Melbourne and in Sydney. And so that's probably put a little bit of downward pressure on home prices. And that's really contra what we're seeing in Perth and Brisbane, which you can see there, the other two lines on the chart. These two cities, and Adelaide as well, not shown, have seen prices more than double since 2020. They've been on a remarkable run, and that continued through 2025. All three cities have seen double-digit growth. They've largely continued to pace through spring and into the end of the year. Choice is a bit more limited in those cities, particularly Brisbane and Perth are not seeing a lot of choice for buyers, and that's probably continuing to support price growth at the margins. If we just drill into Melbourne a little bit more for a moment, the declines that we saw towards the end of last year were a bit larger for detached houses. So again, same idea with this chart as on the previous, but splitting by house and units. You can see that houses grew a lot faster during the pandemic than for higher density, so semis and apartments. But they've been more or less tracking one for one since then. But the falls that we saw at the end of last year were a little larger around houses. And you can see that pattern repeat if we look at the price segments. So here I'm breaking up the market into the most expensive in the red, the sort of middle in purple, and the more affordable in blue. And you can see that those price declines were really concentrated among that more expensive end, which is also, consistent with detached. Obviously, they tend to be more expensive. Similarly, if we look where in the city we've been seeing softer prices, the inner city has been softer than, more affordable areas, places like Sunshine, Frankston, where price growth has been, more high single digits, even up into double digits. Whereas some inner city areas have actually seen prices basically flat over, the last over the last 12 months or so through 2025. So a bit of a divergence there again between the sort of more affordable parts of the city and the more expensive. And that's kind of consistent with the fact that, housing affordability is very challenging at the moment. It hasn't deteriorated in Victoria as much as in some other states because home prices haven't grown as much. But the rapid increase in mortgage rates that we've seen over the last few years means even in Victoria, affordability is far more of a constraint than it was back, pre-pandemic in the 2010s or, certainly during 2020 and 2021 when rates were at record lows. Moving away from home prices for a little bit and talking about, what we're seeing in terms of market activity, 2025 was a relatively busy year across Melbourne. So this chart here shows the number of new listings by month. And we look at it this way because listings are very seasonal. December's very quiet, October, November are very busy. And so you want to be able to compare kind of month to month. And so that's what this lets you do. Each color represents a calendar year and you kind of follow it through and compare it to other years. And so in the blue for 2025, you can see it's well above an average year in the black, though, worth noting that includes COVID. So, does drag the average down a bit. But still, a busy year, but still a little bit quieter than what we saw through most of 2024. You can see in the red there, mostly above the blue line, spring more or less in line, but the rest of the year a little bit quieter this year in 2025 than what we saw in 2024. That said, that still represents a fairly healthy level of choice for buyers, as we were talking about before, and that's probably, particularly through spring, through that peak period, probably put some downward pressure on home prices. In terms of, where that activity was above average through most of the city, with the exception of the Mornington Peninsula, that was a bit below average. The kind of inner Melbourne area was particularly strong relative to average, seeing, a relatively healthy amount of listings through last year. I'm going to change topics now and talk about rental markets for a little bit. And I'm going to start where I always start when I talk about rental markets, which is with rental vacancy rates. So rental vacancy rates just measures the share of all rentals that were available for someone to move into as at the end of the month. As you might expect, can be a very volatile measure. Obviously it depends on the month of the year. Certain months see more people moving than others, but also on things like, when in the month someone moves out as to whether, it's vacant as at the end of the month. So it can be a bit volatile from month to month. So you want to kind of look through at the broader trend. And when we do that, when we look through at that broader trend, what we see is that rental availability is still pretty tight. It's still sub 2% in Melbourne. It's around 1.5% regionally. If we're looking at capital cities as a whole, looking broader than just Victoria, you can see, we're around 1.5%. Regional areas, even a little bit below, looking at regional areas as a whole. So still very tight conditions. That's lower than what we'd consider kind of more normal, sort of 2 to 2.5%, what was typical pre-pandemic. But it is a little bit better than we were seeing back in sort of 2022 and through 2023 when, rental availability really hit its low point. Rents were growing very, very quickly. That was a very, very challenging period for renters. So the sort of broad story is one of improved availability, but still quite tight conditions overall. And what that means and what that's translating into is we are still seeing relatively brisk rent growth. Rents across Melbourne are up about 2.5% over the past year, which is not as fast as some other parts of the country and, not enormously faster than what we were seeing through the 2010s, but it is still, relatively brisk growth. And, importantly, that's in an environment in which availability has actually improved compared to what we were seeing a few years ago when rents were growing at, double digits or even, up towards 20% pace. So that means that over the last, few years, we have seen very, very strong growth in rents, though in Melbourne, perhaps not as strong as we've seen in somewhere like Brisbane, like Adelaide, like Perth, or even to some extent Sydney, which has continued to see a bit stronger rent growth and a bit more limited availability. That picture of, relatively tight availability, still relatively solid growth in rents has been translating into a lot of investor activity around Australia. Victoria had sort of stood out in that it really hadn't seen as much of a pickup in investor activity. There's a few reasons for that, but this chart here, I think, kind of underlines the point. This is just showing the number of new investor loans that were taken out across Victoria. You can see that pick up during the pandemic. That was not a story of investors. That was a story of just housing markets in general being very busy. If anything, investors are underrepresented in that period. You can see activity calm down as the RBA raises rates. And then you can see there's a little bit of a pickup, but a fairly gentle one through the next couple of years. And that's not what we see in places like Queensland, in WA, in South Australia, in New South Wales, where we see a much sharper pickup in investor activity over the subsequent years as rental markets remain very tight, rents are growing very quickly. That's true in Melbourne as well. But crucially, we don't see the sort of policy changes that we've seen in Victoria. But even in Victoria, as we get towards the end of 2025, we have started to see that ramp up in investor activity after that lull. And actually, the number of investors buying at the moment is as high or even a little bit higher than we were seeing at peak during the pandemic in Victoria. That is equally true if we look across other states. Other states are seeing sort of record levels of investor purchases at the moment, or near records. But even Victoria looks like it's starting to catch up amid relatively tight, albeit maybe not as tight as elsewhere in the country, rental market conditions. In terms of where that investor activity is concentrated, it's in the more affordable parts of the city. So this chart here is just showing where investors are inquiring. So a deeper red means investors make up a higher share of inquiries in that region. The top areas here are, Frankston, Sunshine, Tullamarine, Broadmeadows. The inner city obviously shows up very high as well. That's not a surprise. It's a big rental market. You'd expect to see a lot of investors there. But investors are, favouring those sort of more affordable parts of the cities. And that's not unique to Melbourne. We see that kind of writ large across our capital cities. So just to wrap up on investors, but before I kind of move on to the outlook, I think this chart, I like this chart as a way to kind of underscore the point about how important investors are in the market around Australia and increasingly in Victoria as well. And so what this chart is showing is the share of new housing lending going to investors. So you can think of this as kind of a proxy for what share of the buyer pool are investors. It's not perfectly one for one because not everyone buys with a loan, but it's sort of the best proxy that we have. If you look at New South Wales, at the moment, 45% of loans are going to investors. Not a record, but very high relative to historical levels. You have to go back to kind of 2017 to find equally high. Queensland, WA, 40% of loans, as high as we've seen. Again, not quite a record, but very close. South Australia, Northern Territory, similar story. December was just lower than September, and September was a record for both South Australia and the Northern Territory. So kind of around most of the country, investors are making up close to or their highest share of lending, so of the buyer pool, than we've ever seen. Victoria, that just hasn't been as much the case. You can see there through that, kind of post-pandemic period, investors making up about 30% of new lending, and that's relatively low for Victoria. But towards the end of 2025, that started to change, and we saw a big pickup in as we were talking about before, investor lending, and more of a pickup than we saw from other buyers. And so investors are making up an increasingly large share of the buyer pool in Victoria. All right. I'm going to move on now to some themes that I think are going to be important over 2026 and potentially beyond. And I'll start with maybe a bit of a negative one, I suppose, which is residential construction remains relatively challenging. So the chart here is showing the number of homes that we've built by quarter. For blue is higher density, so semis and apartments, and for red is detached houses. Starting on the left nationally, you can see we're still building kind of a pretty consistent number of detached houses, and we'll talk about that more in a moment. But you can see higher density remains well below the sort of pace that we were building 10 years ago. And as a result, we're just way behind that dashed black line, which is the pace we would need to hit the 1.2 million homes over 5 years. Victoria, on the right, is a lot closer. And that's, a fairly consistent feature. Victoria has consistently, throughout the last few decades, just built a lot more homes per person than everywhere else in the country. A lot of that is detached, as you can see there, out to the sort of west. Victoria does just build a lot of detached houses. But even, in the higher density back a decade ago, Victoria did build quite a lot. We're not seeing as much today, though, obviously high density can be quite volatile from quarter to quarter. And we're still below the pace, but not as far behind in Victoria as in places like New South Wales, which is a much further way behind the pace. The fact that we're still building a fairly consistent number of detached houses at the moment is actually a little bit surprising because we started building a lot during the pandemic. And that was on the back of home builder during that period, as well as low interest rates. That didn't actually translate into completed homes as quickly as we might have thought for a few reasons. And those are why the sort of residential construction sector have been a very challenging sector. And that's costs were escalating very, very quickly. Labor was quite hard to source, and build times blew out during the pandemic. The good news, to end on a more positive note for the residential construction sector, those big headwinds look like they're starting to improve. Costs are still high. They're still higher than they were pre-pandemic. They're not coming down, but we're not seeing the pace of growth in costs that we were during 2021 and 2022, which means that environment of uncertainty around costs is not as true today. There's just that bit more certainty. And so while it's still more expensive to build, and that's obviously still a challenge, it is a bit more predictable than it perhaps was. Labor availability does look like it's improving as well. It's still challenging, but we have been seeing employment in residential construction increasing. And build times, again, they remain longer than pre-pandemic. It is still taking longer to build homes, but we are starting to see that time come down. So we're headed in the right direction there. So while we're still a long way behind, it's still a challenging set of conditions. There are some signs that things are looking more positive than they have for a while. The second theme that I think is going to be important for 2026 is first home buyers. And the reason for that is that we saw some policy changes at the end of 2025 from the federal government to support first home buyers. So the big one here is the Australian government 5% deposit scheme, which is essentially LMI from the government for first home buyers. You can buy with a 5% deposit and not have to pay LMI. Schemes actually existed for a while, but it used to be capped prior to 1 October. There were income eligibility limits, so you had to earn under a certain income threshold, and there are only 50,000 places a year. Both those caps have been removed. There is still a cap on how expensive the home that you buy can be, though it's relatively high for a first home buyer. 950,000 in Melbourne is, for some first home buyers, going to be a constraint, but for many probably won't be. The other scheme, which is newer, only as of early December, is the Help to Buy scheme. This is the shared equity scheme where the government kind of buys a stake in your home alongside you. This one does have eligibility caps on income and on the number of places, so it'll probably be a more limited program than the 5% deposit scheme. These will unequivocally pull forward some first-time buyer demand and allow some people to buy a bit sooner. It's obviously still early days. This expanded version of the program started 1 October, which is, in housing market terms and in looking for a home, still relatively recently. But there is some evidence, maybe, that we're seeing some of the impact from that. This chart here is showing the number of first home buyers across Victoria. And you can see right at the end of the year there, which covers the 3 months that this scheme existed in its expanded form, you can see a bit of a tick up in first home buyers. It's not huge. Obviously, the number of first home buyers can bounce around for a lot of reasons, so I wouldn't want to pin everything on this. We did see a bigger increase in New South Wales than we saw in Victoria, but there is some evidence that perhaps we're seeing the effect of it already. And so it'll be interesting to watch as we get through 2026, as the policy's been in place longer, as more people have had a chance to get pre-approval on it and find a home, whether that starts translating into more first home buyer activity. That activity will obviously be concentrated in those more affordable segments that first home buyers tend to favour. And then just to wrap up, I started with inflation, so I'm going to finish with inflation as well. Inflation really is going to be the kind of key thing to watch this year. And I like this chart as a way to kind of underline that point. What I'm showing here in black is the actual RBA target cash rate. And then in red, what markets were expecting at various different points in time. And so in the red is what was expected back in late October, not even that long ago. But crucially, it was before we got the September quarter inflation data. And you can see that at the time, we were expecting about 2 rate cuts on that basis. But then we get the September quarter inflation data, get to the blue line. Inflation looks more persistent. We've gone from expecting cuts to expecting, 1, maybe 2 hikes. And then after that blue line, we get the December quarter inflation data. And that shows, nope, inflation's actually definitely entrenched and even higher than we thought it was. And we move from there to the purple line, which is we've already had 1 hike, there's at least 1 more to come, and 40 to 50% chance of a second. And so the point here to make is twofold. One, that's the outlook for cash rate. But two, that outlook is completely dependent on what happens with inflation. If inflation evolves as the RBA is forecasting, we probably get the purple line. But that may not be the case. It may be that September and December were a bit of a blip, and in fact, inflation is headed back in the right direction, and we, don't need to see those hikes. Whether that's true or not will, become clear each month as we get inflation data over 2026. But that's what's going to drive the outlook for the cash rate. With that, I will wrap up. Thank you very much for your time. I hope you found that helpful.